Hey everyone, it's Michael Rosmer here with Richucation. Welcome back. We're here today, right now, in this video, to talk about the first rule of investing. We talked previously about how there's 5 rules of investing, and these rules are a really big deal. These rules are not made to be broken, and I want to again clarify that this is for investing versus trading, and there's some distinctions there. There's a bunch of depth to this one. And so I'm going to cover it high level, and then we'll have subsequent videos where we go into the details. But the first rule, so rule number 1 is not Warren Buffett's rule number 1. For those of you who know, Warren Buffett's rule number 1 is don't lose money, and rule number 2 is never forget rule number 1. And a lot of this comes from when I studied, because I'd gone through, hearing this, and myself and people that I had known, a lot of people in my circle had lost a lot of money. And the question was, okay, it's nice to say don't lose money, but how do you do it, right? And we're going to answer that question. We're going to get into it. It's going to be not just in this rule, but if you follow these 5 rules, it's amazing what it will do for your investing. And this one in particular is the most powerful one. It's the foundation of all the others, and it's going to make all the difference, which is, and this is a Warren Buffett rule as well, by the way, even though he doesn't call this rule number 1, Warren Buffett actually strongly suggests and adheres to this rule. So it is understand what you're investing in. Okay? Understand what you are investing in. Now, if you don't understand what you're investing in, you're speculating, period. Okay? You're just guessing. You're throwing the dice. You might as well go and buy lottery tickets almost. Not quite, but and that's why, generally speaking, for somebody who doesn't understand, we have some really basic, simple principles of put your money here, which is what Warren Buffett says. Warren Buffett says, okay, 10% of your money in cash, 90% in an index, a low-cost index fund of the S&P 500. So for those of you who are taking notes, and in our investing mini-series, we talk about some of that, etc. Anyway, that's kind of like, there's a whole bunch of different things we could do. The point is, there's a few simple things to stick to if you don't understand it. So we're going to get right into this. I want to make it as quick as for you as possible, but recognizing also that there's a lot of depth to these. So if we're going to buy something, we're getting into investment, what's the first thing that we want to understand? Well, we want to understand how to value it, okay? Because what you're doing is you're buying something, how to value it. What does that mean? Well, if you go and buy a house, if the house is worth $500,000 and you pay $1 million for it, that was a bad investment, period, okay? We're going to talk more about that in subsequent rules, but you have to understand, what causes there to be value there, and that's the thing that I want to really get into. So this is intrinsic versus price. So the price you pay, Warren Buffett would say that Ben Graham told him, price is what you pay for something, value is what you get for it. And you want to pay less than the value that you get. And again, we're going to talk about that in a subsequent rule. But in order to do all that, you have to figure out, how do I value it? What are the things, and for each investment it might be different. If I'm buying bonds, there might be different factors. If I'm buying businesses and certain types of businesses. So when Facebook goes and buys WhatsApp for $17 billion, did they get a good deal? What about when they bought Instagram for $2 billion? What about when Google bought YouTube for $2.4 billion or whatever, and it was losing a couple $100 million a year or something insane like that? When you have those situations, how do you value it? You obviously value YouTube in that situation differently than you would value Coca-Cola when you're Warren Buffett buying it in the 80s, right? So it's really important. How do you value it? Okay, so if you don't understand how to value something, stick to a diversified index or, something like that, okay? Number 2 is, and this goes into here, which is what's going to cause it to go up and down. What causes the value to rise or fall? Again, because if you're buying an investment, you want it to go up, right? And if you don't understand what's going to make it go up, then how are you going to be able to accurately predict whether it's going up or going down, right? So you need to understand what are those factors, okay? And that ties into how you value it for sure, right? It's worth noting that this should be short and long term, right? So short plus long, and of course you won't be able to read this, but I'm articulating it for you. So, okay, so that gives you a little bit of a sense. All right, we've got how do we value it? Now, is that enough? We want to go a level deeper. And this is a lesson that I learned. It was a real estate investment that I was asked to make in 2000 and maybe 2008, I don't know, 2007, somewhere around there. Basically, there was a condo, an apartment building, and some friends of mine owned it, and they were refinancing. And there was a gap in the amount of money they needed of about $300,000, okay? So they said, great, we want to borrow this money. And so I talked to another friend, and he said, okay, well, you know, they really need the money, so give them steep terms. And, you know, there's a risk, so also give them steep terms. So at the time, I said, all right, it's going to be 2% a month money. And if you default, here's what's going to happen, and blah, blah, blah. And they said, oh, that's pretty expensive, let's go talk to some other people. And there was also a possibility of, like, I think a $30,000 bridge. So it was like they could get the $300,000 if they could get a $30,000, anyway, whatever, however it worked out, wasn't really the important part. The important part was I learned a really, really valuable lesson at that time because I was willing to go and make that investment, okay? I thought, oh, you know, good return, blah, blah, blah. But what I didn't realize is I probably would have lost the money if that had happened. It turned out it didn't. They found an investor somewhere else or lost the building or whatever happened. I can't remember because there was a whole flurry of portfolio stuff going on at the time. But what took place was I sat down while they went back and I did the numbers. And I said, okay, well, they've got this building that's worth however many millions of dollars, okay? And their cash flow, the like rental income that they're bringing in is this. And here's the interest rate that they're paying. And like when I did all the numbers, it was impossible for them to pay me 2% a month. They could not do it. They would have said yes because desperate people will say yes to all kinds of things. But it was impossible for them to fulfill on it. The building simply wouldn't make enough money. It would have needed to appreciate and value a whole bunch, which at that time was insane, right? And yeah, so it was a bad investment. And so that had brought me to this lesson, which I've gone way deeper on since then, and it is, how does it make money? So people will come to me and they'll once in a while say, oh yeah, what was one of the ones I heard? A friend of mine, I was looking at, introduced some people to, it was in an investment circle, this was, again, I don't remember what year, but, and we were looking at some pretty solid, fairly solid investments, or what seemed to be fairly solid. Actually, one of them didn't do so well, so at the time, that was, you know, again, in this learning curve. But they weren't investments I was doing, but I'd introduced them to somebody who was, and unfortunately, some other people that I knew invested, and that didn't work out so well. But those guys were promising, I think, 12% rate of return, right? It was like 1% a month, or maybe it was 10% a year, whatever. I was on a life insurance product. And anyway, these guys in the meantime went and found somebody who offered them something asinine, like 400% in 3 months or something like that. And I said, you're going to lose all your money. Very simple. How do I know that? Well, here's the question. Where is the money going to come from? All right? If I give you $100,000 and you're going to give me back $400,000 or $300,000 or whatever the number happens to be in 3 months, where will the money come from to pay me back? Because if it's really solid, most of the time you don't need to pay a ridiculous rate of return like that. It's just not going to happen. Unless it's a super small amount of money. It's like, okay, I'm lending you $1,000 or $5,000 or something, and just it's not worth anyone to do the due diligence. So you have to cut them into the deal or something, whatever. But very, very rare. So how does it make money? Where's the money going to come from? Every investment, in order to provide you with a rate of return, money has to come from somewhere. So maybe you're renting, right? You have rental customers. Okay, that's where the money is coming from. Gold, what does it do? Well, it doesn't give you any money. So, how does it make money? It doesn't. It's just going to sit there. You're hoping that the supply and demand over time is going to drive the value up. But really, it's not a real investment. It's just a storage of value, right? What about a business? So a business is probably one of the best ones to look at because a lot of people really don't understand how to value stocks and this. especially long term, okay? So here's what you need to understand. Number one, who is buying? Number two, what are they buying? All right? Because that's where the money's coming from. There is a market of people who are going to pay for something, and if that market is going to disappear, or if those products aren't going to be things they're going to want to buy over time, you're going to have issues. Or if the value of those products goes down, or the margin in those products goes down, or on and on and on, right? So how does it make money? You need to understand that. And again, we'll do a whole video on this and cover it in detail. Along with that is what causes it to rise or fall. What causes rise or fall? Because again, when you invest, you aren't buying today, right? You're not buying based on what's going on today. You're buying based on what's going to happen in the future. And it might be okay today, but if tomorrow everything's going to crash, like Enron or WorldCom or any of these frauds, then you've got a problem, right? So, which, by the way, actually we'll talk about that in a future video. But so anyway, what would cause the amount that it makes to rise or fall, okay? Now, beyond that, what are we going to look at? So we've covered, how do we value it? What's going to cause the value to rise or fall, short term, long term? How does it make money? What's going to cause the amount? How does it going to increase or decrease? What else have we got? Well, we've got how could you lose money? How could you lose money? And this is not just a question of these, okay? That value, etc. Because now you have to introduce things like fraud. Hey, the person could run away. Hey, the deal structure could be really bad. Somebody else could swoop in there. So as an example, maybe you're putting a second mortgage on a property, and the property's solid, but the first mortgage holder is then going to end up putting it into a situation where you're going to have an issue. So lots of different things. How could you lose money? You have to, or hey, listen, what could happen is that you're forced to sell at a time when the market is down. Again, doesn't necessarily affect these, but here. So again, we're going to talk more about those in future video. But how could you lose money, and how can you protect yourself? If you don't know how you could lose money in an investment, you have no business investing in it. If you don't know how to protect yourself from losing money, then don't invest in it. How can you protect yourself? And again, as always, there will be lots of this in future videos. So, because this is really, really detailed, in-depth stuff. This is like the master class of investing. If you understand this and these rules that we're going through, these 5 rules, then you can do very well just drilling into that deeper and deeper. It's not, the principles themselves are not complex. It's just learning the application of them can take an awful lot. Like, how do you value? Very tough question. What's going to cause how does it make money? And trying to predict that short and long term, very challenging. So what else have we got? Well, we've also got to understand what is the market for the investment. What is the market? So this is, the buyers, the sellers. How does that work? And this plays into the value, and we can actually talk about it right here, which is, what is my exit? Because if you don't have a market for it, then there's no exit. And if you don't have any exit, you can't realize any return. Okay. So that's next. What other things have we got to consider? We're mostly through. We need to understand what are our time frames. And this is not so much to do with the investment as your investment strategy and how it fits into your life. So what are our time frames? And so that's, how long is my money going to be tied up? If I'm going to need the money in 3 years, but it's not going to be ready for 5, I'm going to have a problem, right? And then finally, what goes along with that are what are the fees, or what are the costs? So a lot of people get wiped out by fees and costs. Not wiped out. It greatly undermines their rate of return. Sometimes makes it negative. So this is kind of the basic rubrics. If you have these things figured out about an investment, you understand, how do I value it? What's going to cause the value to go up or down, short or long term? Okay? And there's going to be a bunch of those things. How does it make money? Okay? And a lot of people get way too simple on this. So like if I look at a bank, okay, so I love investing in Canadian banks. You say, okay, well, who are the customers? You know, we can go through and there's a lot of different customer segments, right? So I can't just say, oh, well, you know, it's whatever, retail investors. No, it's not. It's, you know, businesses through, and I would break it down by product type, right? So I can say, well, they have merchant processing, they have credit cards, they have lines of credit, they have banking, like actual like deposit taking, you know, transactional banking. They've got foreign currency transaction. They've got insurance. They've got investment sales and investment management and platforms, and you know, all these different things. And so I can start to understand, well, how do they fit into that market? Then I can go and look at what's the competition, right? Is that an entrenched market? Is it likely to get disrupted, etc.? So that's how does it make money? What causes it to rise and fall, short and long term? Like I should consider management, right? If you have an issue, especially in smaller operations, management can come and destroy it. Or if it's not a like well-entrenched business. So Warren Buffett's famous for saying, we want to buy businesses that an idiot could run because one day one will. All right, so what else have we got here? So how does it make money? What could cause the amount of money it makes to rise or fall? How could you lose money? Okay, very, very important. How could you lose money? How can you protect yourself from losing money? What is the market? What is my exit? What are our time frames? And what are the costs? You could factor in here somewhere what is like the, you know, what you should factor in the probabilities around this and the potential. Okay, so I'll just make a note about that at the end here. Probability and potential. So probability is like what's the likelihood of those things happening, because anything could go wrong, right? So in North Korea, Warren Buffett would talk about how you can get these companies at low multiple. Not North Korea, South Korea. You get these companies at low multiples because there was a perceived risk of North Korea having a war with them and that destroying it, right? So the question is, what's the chance of that happening, and is that accounted for fairly within the values of the companies, right? And then what's the upside is very important as well. That's where we get into the concept of a 10-bagger, which is a Peter Lynch concept. So again, we'll talk about all of that in the future. I hope this gives you a nice overview on understand what you're investing in. This is like, these are the questions. Like when I go through and I'm working with somebody on investing, I'll ask them this about an investment, and most of the time they can't answer it. So we'll see you on the next video.